Hi everybody. Today we're going to be looking at the S&P 500 ETF based on the closing data for Monday, June 8th, 2020. Now what we have here is a graph from TradeStation. It's a program that I use very heavily to help analyze my stocks. What you see here are multiple indicators, most of which I created by myself and programmed to help me stay on the right side of the trade. The graph on top is the S&P 500 ETF. Overlaid on that are moving averages, 9 days, 21 days, 50 days, 89 days, and 200 days. These are all the key moving averages that I found to be pretty significant, and I have taken all these indicators and weighted them. When the stocks are above a certain number of these moving averages, I have a bet sizing mechanism that increases the proportional bet size and decreases it accordingly when the stock moves below these moving averages. And what you see here is this equity percent target is that indicator that combines all those plus a momentum factor. So as the trend is moving up, you'll see that the equity percent target increases, and as the trend is moving down, you'll see that the bet sizer, what I like to call it, starts to move down significantly. So at the peak of the market, around February 20, the bet sizer was at 100%, and then when it crosses below some key thresholds, it starts to drop significantly. On February 20, the bet size was 100%, and then February 21, the bet size dropped to 60% because it crossed below a key short-term moving averages, one of the key short-term moving averages, and one of my key momentum indicators that I developed also went negative. Had we done that and followed the strategy, the bet sizer would have shrunk its position further on Monday, February 24, from 60% to 20%. And what I found is that a trend following mechanism like this really helps protect you against some significant losses, as we've seen. Over the course of a couple weeks, the market fell about 30%. It's ridiculous, but that's the nature of the markets nowadays. It's being driven a lot by algorithms and momentum traders, and what I found is that it has a very high propensity to follow what the average price is for the past 2 days. If the market has gone up for the past few days, typically it'll go up on the third day. Conversely, if the market's been down for the past 2 days, it'll also go down on the third day. What we have here are the bet sizer indicators, the momentum indicators that I call wave balance, the accumulation that looks at the buying and selling pressure, RSI, which is an overbought oversold indicator. As you can see, when it falls below this line, that's when the markets are oversold. But as we have also witnessed, oversold indicators often do not work very well in downturns, in downtrends. So you may have been given a buy signal here that it's oversold, but that's when this buy was only at 296, and had you used an overbought oversold indicator like RSI, it would have gotten you in for a short-term profit, but had you held on longer, you would have had a significant loss. So that's why it's important for us to always pay attention to the trend and have that play a greater role in our overall trading strategy, as opposed to paying attention to just overbought and oversold indicators. The DMI I found is incredibly powerful. If I had only one indicator I would use the bet sizer indicator, but if I couldn't use the bet sizer indicator, the DMI is pretty good. It basically pays attention to the buying pressure. Is the price tending to move at the upper end of its channel or the bottom end of its channel? And it tracks that. As you can see here, when this red line crosses above, that means that the prices are falling at the bottom end of its channel, and the propensity of it is to be bearish. And it got bearish also at the same time that my bet sizing indicator went negative, and basically stayed negative for the whole time until it started to recover right above here in April 7. By then my bet sizer indicator was already starting to tick up a little bit, but DMI, it's pretty good. It keeps you on the right side of the trade, and it's been significantly positive all throughout the past few months, as was my bet sizer. But as we can see here, over the past few days, RSI has gotten overbought. It's gotten beyond the 70 level, and typically you find that the market will pull back a little bit or basically just stop rising until it stops to gather its breath. One other thing that I like to watch out for is the VIX. I also found this to be incredibly powerful. So this is an hourly chart of the VIX, and one thing that I have noticed is that it tends to give you up to a 1-day lead on how the stock market may behave over the next day. When the momentum of the hourly chart for the VIX is positive, that tends to be an area where the market advance tends to either stop, pause, or just turn into an outright decline. As of yesterday, on Monday, because now it's Tuesday morning, as of yesterday, right about in the middle of the day, the VIX started to go positive, and I've learned to be very, very cautious. And if you have any overly large bet sizes, it's a good time to shrink that and reduce leverage and to just play a little bit of defense. Let's take a look at some other time frames when the VIX has moved positive. Let's see, we see that on May 12th, right near the end of the day, the VIX started to go positive. And if we look at what the market did on May 12th, there we go, May 12th, the market had dropped pretty significantly on that day, and it did proceed to fall for a couple days before it reversed significantly. As a short-term timing mechanism, the VIX is one of the better indicators that I've seen. If you take a look at how it behaved right near the peak of the market, you'll see here when VIX was just very sleepy in the teens range, you can start to see that the volatility started to get positive about February 18th or so. It started to tick up significantly above this zero line, and then the 21st, and then boom, the 24th, it really started to take off. Once this is positive, it makes a lot of sense to reduce your bet size, reduce leverage, and basically just get ready for some bad price behavior. You can get a momentary break. That's when you can start to try to make your bets again. But once it gets positive again, you need to start to be cautious. And that's when, right about here, the volatility peaked. And the interesting thing was the market was still falling, but the volatility had been peaking. And if you had made some bets in the options markets, you would have been seeing a collapse in the implied volatility, even as the market was falling. It was very unusual, but it was a good sign that maybe the market was starting to top. or rather, the VIX was starting to top and the market was starting to bottom, and we did eventually get that bottom in late March. And as we saw going in May, we've had a really strong rally. But going back to recent events, the VIX is positive. We don't exactly know what'll happen going forward, but we do know that the odds for declines tend to go up significantly. So I have been reducing my bet sizes, reducing my leverage, and basically getting ready for some potentially bad news to happen. We have the Federal Reserve coming up on Wednesday. They'll be talking about interest rate policy, and with markets pretty much near the old highs again, well, at least very close to it, there is a non-0% chance that they may taper off some of the quantitative easing programs that they've got, and I think the market's a little bit nervous about that. So let's take a look here. One of the other indicators that I like to use is the Heikin Ashi indicator. This is the indicator that basically gives me an idea for where the algorithms may be betting for the market. What you'll see here is that when the candles are red, the market tends to fall, and when the candles are blue, the market tends to rise. It's an amazing indicator. If you had just basically bet according to the colors of these candles, you would have been on the right side of every single major move since forever. It's that amazing. So currently right now the candles are blue, so the market's very bullish. You tend to get more dip buyers over here, but once the candles start to turn red, that's when you really want to start being a little bit more cautious. So right now the market is still bullish, and we will probably get a little bit of a short-term pullback, but you're going to get a lot of people who missed out on this rally. They're going to probably want to go buy this dip. So that's another thing to look at. Again, these are a number of indicators. We always look at this like as a mosaic. One indicator can't tell you everything, but we look at all the other factors and weight them accordingly. So good luck on your investing and your trading for Tuesday, June 9. Currently it looks like we're going to get a little bit of a dip in the market based on the futures behavior, but we should probably get some dip buyers at some point if it falls a little bit further. But again, pay attention to the VIX. Stay on the right side of this. As long as this is positive, risk is elevated, it's a good idea to not get too extended on any of your bet sizes. All right, good luck.